This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Michael Pento joining us here this morning. Michael is a very well-recognized writer on the web and the president of Pento Portfolio Strategies. Welcome, Michael.
Thank you so much for having me, Gordon.
Well, it's our pleasure to have you. Maybe we could begin, Michael, with you giving our listeners a brief overview of yourself, your background, your firm.
Well, my firm is Pento Portfolio Strategies. I'm the president and founder. We're a registered investment advisory firm located in Colts Neck, New Jersey. I've been a licensed professional since 1992. I've written a book about a year and a half ago called The Coming Bond Market Collapse. We manage money here for institutional and private client investors.
Mike, we're here to talk.
I also record a weekly podcast called The Midweek Reality Check, which is available on my website.
And from your website, they can get access to it.
Yes, www.pentoport.com.
Perfect. Michael, we're here to talk about financial repression, and I wonder if you could, or if we could begin by you explaining to our listeners what, in your words, what you see that to be, this macro-prudential strategy.
In my own view, financial repression is any attempt by government to make sure debt service payments remain serviceable. That's the key. Whether it is to force people into the bond market, whether it is to keep interest rates artificially low, whatever they need to do to make sure they don't have to use the tax base to pay their debt and deficits, they utilize artificial methods to ensure that they can make debt service payments.
What are those methods? What do they consist of?
Well, number one is, of course, as you know, in the United States, we've had a Fed funds rate at 0%, effectively about 0.1%, for the last 6 years running. And, of course, my favorite example is in Japan, where they managed to take the entire the entire JGB market and monopolize the whole entire thing. Whereas the actual trading of JGBs does not occur unless the Bank of Japan is a buyer. There are days on end where there's no trading because their 10-year note is 0.5%. That's a half of 1 percentage point. And that's overlooking the fact they have a debt to GDP ratio of 250%. So this is an insolvent nation. It's taken interest rates down to the point where there is no private market for their debt, and it's a ticking time bomb.
And now they've got the largest pension fund in the world, the Japanese pension, $1.3 trillion. Now selling those bonds from 60% to 35% of portfolio to buy equities.
To who? Let me ask you, to who? Who do you think is going to buy? If the largest pension fund in Japan, the JPIF, is dumping all of these bonds, who's going to buy them?
There's only one person.
Exactly.
That's effectively what they're doing, in my mind, is they're transferring those assets are being moved over, if you can call them assets, over to the Bank of Japan. But what's interesting, Michael, is they're now going to buy equities, not only in the Nikkei, but they're going to buy foreign equities.
Yes.
So here you've got a new...
The Fed ends QE, and the market starts to roll over. You know, as of October 15th of this year, 2014, the equity markets across the board were down. Okay? So you had over 10 months where the averages did nothing during the tapering of QE. And then miraculously, James Bullard, president of the St. Louis Federal Reserve, comes out, and he's a hawk. He comes out and says, guess what? QE might not end. And then dovetailing on top of that, we had Mr. Kuroda, I call him Hiroshima Kuroda. He's the governor, the central bank governor in Japan. He comes out and says we're expanding their QE program to 80 trillion yen per annum, which is the equivalent of about $710 billion. And they're buying international equities. They're not just buying bank assets like they do in the central bank of the United States and hoping that they go out and buy stocks and bonds. They're going out and buying these international equities. So they've taken the baton from the Fed, and it's the equivalent of a $3 trillion, if it was in U.S. terms, a $3 trillion spending spree. And it's this unbelievable, insatiable appetite to completely abrogate the free market system. And you look at China, you look at Europe, you look at the United States, and especially Japan. The free market mechanism has been completely vanquished. We don't know what the prices of anything really is anymore.
Yeah, we don't no longer pricing risk, and we have no longer effective price discovery, in my assessment.
You're 100% correct, Gordon.
That is a frightening, which means that capitalism is not working and cannot work in that environment. And therefore, you get malinvestment, etc. It's
been annulled, it's been canceled and abrogated by governments and central banks, which are pretty much one and the same thing.
It really hurts. A new twist on that Japanese scenario, them buying equities, or specifically the pension plan, buying foreign equities. It's a twist on the currency wars. They're going to debase the yen, drive it down, but they're going to protect some store of value in that they're going to hold foreign currencies that would be up relative. It's the ultimate in a carry trade. I'm sure that's not part of the strategy, but because I'd be giving them maybe too much credit. But
he said sarcastically. Yeah, I think the danger here is that the yen can unravel here and become intractable. We're already at 116 yen to the dollar. They had a trading range of 110 to 115. That's broken through that. And they're continuing to print money and escalating their QE program, where the Fed is supposedly, at least I think, temporarily out of the QE scheme. So there's a chance that the yen can unravel, and you'd have a complete eschewing of all yen-denominated assets, bonds and equities, and that would mean the third largest economy on the planet would absolutely crumble. So not talking about some isolated banana republic like Zimbabwe, but they're following the Zimbabwe model. There's no bond market anymore. Equities are in a massive bubble. They're helping to pervade that bubble across the entire planet. And if interest rates, right now there's 0.5% on the 10-year, as I mentioned before. If interest rates just go up 1 percentage point, 100 basis points, the nation is completely insolvent. And you are in a scenario where the yen could unravel quickly, very quickly, cause the entire economy of Japan to collapse, and that would be massively destructive to all economies and markets across the globe.
I was just talking a while ago to Doug Casey in Argentina, and in all the years he's investing, he says being short the yen is his best investment that he's seen, as it stands right now.
Yeah, we are short the yen here. In fact, we do it very easily using an ETF, and I think we're up about 20% in the past month or so, just in that it's a leveraged ETF against the yen. I can tell you this, though. You have to be very, very, very cautious when you're investing, because I also believe the chances are that the economic data in the United States will turn south. If you look at every time they ended QE in the past, we had the stock market rollover. I'm also watching M2, the monetary aggregate M2. That has gone from a 6-7% annualized growth rate to a 3% annualized growth rate. If you look at M3, which is kept by private sources, that is also starting to fall significantly. So watch out if the data in the United States starts to contract, and I have no reason to believe why it won't. If that's the case, you might get more of these hawks from the Fed talking about QE5, or QE5 is what it really is, but they'll say it's QE4. And that could cause a reversal in the yen carry trade, which again would be wildly bullish for gold, but extremely damaging to U.S. equities.
Agree. It's a valid observation. Michael, how does this end?
How does it all end? Where's
this road leading to?
That's a question that would take me about 3 hours to answer. But I could tell you in the long run, I believe we're going to have to go back to a currency that is backed in specie, gold and silver, a bimetal currency. We cannot allow the whims of a small group of unelected people to depreciate the value of currencies without any accountability whatsoever. Who gave Mr. Bernanke and Ms. Yellen the authority to do all these QE programs? Who voted them into power? Why do we believe that deflation is a bane on the American populace?
There aren't many Americans that would say it is.
Why do we want real incomes to fall and prices to go up? These people are appointed by our president, and we cannot allow them to destroy the middle class and the viability of the American consumer.
Without question on that, Michael. What does an investor do right now? How do they protect themselves? How do they take advantage of this ongoing scenario?
Well, it's a great question, Gordon. Well, first of all, we look at the gold market, and since 2011, 2012, gold mining shares have been absolutely pummeled. They're down about 85%. And I believe it's because of two reasons. Because deficits have come down all the way to $500 billion a year. Now, bear in mind, in 2007, they were about 150 to 200 billion. Before the credit crisis, the Great Recession, they were about 150, 200 billion dollars a year. Now they're more than double that, but that's being extolled as some kind of virtuous, hard money, hard fiscal policy. But I believe, and it is my conviction, that eventually you're going to have a complete lack of credibility in central banks. And if that's the case, and I think that's where we're headed, since the gold market has already been completely wiped out, you have to own some gold here because, as I said before, if we have to go back into another QE program, and I will tell you this, whenever interest rates normalize, let me give you one little statistic. Global debt is up 40% since 2008. The U.S. debt is up $7 trillion since 2008. And we're still at a record 320%, very close to a record 320% of total debt to GDP. So the problem hasn't been solved. It's just due to financial repression, we'd be able to take debt service payments down to near zero. So whenever interest rates normalize, and there's two ways that could happen. The Fed could take them there, highly unlikely, or the free market takes them there because we're so far behind the inflation curve. That's where I think we're headed. So when interest rates normalize, you're going to have a complete collapse of the financial system. You're going to have a complete collapse of global economies, and the tax bases will be wiped out. So debt and deficits will skyrocket, and that's what's on the other side of all this. You asked me where all this is heading. And therefore, QE, financial repression, and even a further intrusion into free markets lies just ahead. And that's why you have to own gold right now. And I do own gold mining shares. I am short the yen. And if those are your two strategies that you hold on to, I think that's the best bet. I don't want to ride bubbles and go to sleep. Not here, not now.
This problem started with removing ourselves from sound money, and when you have unsound money, all these kinds of things start to unfold. And there's never been a fiat currency in history that's survived or hasn't fallen into this trap. Is that too negative a statement, Michael?
No, not at all. It's an absolute truth. I'll tell you this, before you're talking about isolated, Weimar Germany wasn't the world's biggest economy. You're talking about Zimbabwe, Georgia, Bosnia. Now you're talking about all of the major developed economies. You're talking about Europe, which in aggregate, EU 18 is the largest economy on the planet. You're talking about the United States. You're talking about Japan. You're talking about China too. China has increased its debt 25 times since the year 2000, trying to create a fixed asset bubble, which is digging holes and filling them in, unsustainable, unusable, and economically unviable. So now we're not talking about some one isolated banana republic. We're not talking about one isolated small economy. We're talking about the complete collapse of the entire fiat currency regime, and that is coming down the line, and it's coming down the line quickly.
Is there any way that that won't happen, or there's a way around that, Michael? It's even a possibility?
The only possibility I see, the only real legitimate possibility I see occurring is to explicitly default on the debt. And I don't see that happening voluntarily. So it's not really, I mean, we could do something with like the Greeks did, just cancel the debt. But then again, even then, you're talking about a complete wipeout of the tax base. And then if you have no tax base, your deficits skyrocket and your debt skyrockets. So I don't see an easy way out of it. And believe it or not, and I'm a patriot, I love the country, I want the best for people and everyone involved. But the best thing to occur is to have this current regime annulled. I want us to go back to a currency that's based on hard money. I want to make sure that banks don't use the money multiplier effect to take base money and expand it by 15% year after year after year like they did in the middle of the last decade and create endless iterations of bubbles. That has to stop. That has to end. And unfortunately, we're nowhere near that yet.
Michael, we're out of time. I know you're rushed here today. What message would you leave with our listeners and investors?
Well, I would say that the Jack Vogel buy and hold a diverse group or modern portfolio theory of investing where you own some bonds and own some stocks and just take a nap and 30 years later it'll be fine. That is no longer relevant. You must keep a very close eye on your investments. You know, people are out there buying annuities right now saying, how much money do I need until I retire? The one factor they never talk about is inflation. What if we lose control of the money supply? What if all of the debts, instead of being defaulted on explicitly, are defaulted on implicitly through inflation? What happens if your annuity that guarantees you 3% per annum is being paid back when your inflation rate is running in the double digits and the money you have has lost all of its purchasing power? So you can't fall asleep. You have to have a dynamic investment strategy. This is what we do here at Pento Portfolio Strategies. You have to model the growth rate in the money supply. You have to model the strength of these currencies, and you have to stay very, very vigilant.
How do listeners learn more about what's happening from you, what you're viewing things, and your strategies?
So you go to my website, www.pentoport.com. You can email me directly using mpento@pentoport.com. I publish a weekly commentary. I record a weekly podcast, which you can subscribe to at the website for a free trial. And, of course, the best thing you could do is become a client.
Michael, absolute pleasure. Thank you very much for joining us here today, and I hope to have you back again.
Thank you for having me, Gordon.
Thank you. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.